welcome to the deep dive. When you think about transportation, every road, every flight, every port, it's easy to just see it as moving stuff around. But it's so much more than that, isn't it? It's really about access to jobs, education, communities, fundamentally a better quality of life. Transportation is this vital enabler, an economic equalizer for millions.
That's exactly right. And that's precisely what we're going to unpack today. We're doing a deep dive into the African transport sector, zeroing in on a really key week, June 16th, 22nd, 2025. It turns out this period was, buzzing with significant strategic shifts and some genuinely surprising developments across the continent.
Okay, so our mission here is to take all the insights from our source, the African Transportation News Analysis Intelligence Briefing. It's really comprehensive, and distill the most crucial bits for you. We want to help you cut through the complexity and really grasp the dynamics at play. We're talking everything from those huge, high-level investments and policy goals,
right down to the ground-level realities, the things that can sometimes make or break those grand visions.
Exactly. So expect us to connect some dots today across aviation, maritime, land transport, maybe uncover a few surprising facts along the way.
Yeah, looking at how those big macro ambitions meet, or sometimes clash with, the micro challenges. Should be interesting. Let's jump in.
All right. Let's start with the big picture, the strategic landscape. And maybe the first thing to grasp is just the sheer scale of investment needed. Africa is facing this, massive hurdle, an estimated $150 billion annual transport infrastructure investment gap.
$150 billion every year. That's not just a big number. It's what's seen as necessary to support the kind of growth they're projecting, maybe 6-8% compound annual growth for the sector between now, 2025 and 2040.
And you can see countries trying to step up, right? Like South Africa, they've earmarked our $940 billion. That's about $50 billion US dollars for infrastructure over the next decade.
It's a huge sum. But here's the kicker. Our $100 billion of that, they're counting on coming from private and international investors. And that really highlights this continent-wide shift we're seeing towards public-private partnerships, these PPP frameworks. The idea is to create, more agile, investor-friendly environments.
That makes a lot of sense. And I noticed something interesting, the co-location of big events, like the Transport Evolution Africa Forum, happening alongside the Big Five constructs, South Half Africa, and the Infrastructure and Water Expo. That feels significant.
Oh, absolutely. It's more than just convenient scheduling. It signals a fundamental shift in thinking, moving away from funding sort of isolated projects, just build this road or upgrade that port,
towards developing integrated economic corridors.
Precisely. Think of it like building the entire circulatory system, the economic arteries, not just fixing one vein. For investors, this means they can see the whole picture, the port, the rail link, the road access, the power supply all together. It makes the investments feel more complete, more logical, and ultimately more bankable.
Okay, and what's really driving all this? The engine behind this push for investment and integration. It has to be the African Continental Free Trade Area, the AfCFTA, doesn't it?
Without a doubt. AfCFTA is the catalyst. It's projected to cause maybe up to a 50% surge in intra-African trade. That's huge.
50%. Wow.
Yeah. And the UN Economic Commission for Africa, UNECA, they're forecasting something like 28% increase in demand just for intra-African freight by 2030.
So what does that mean in practical terms? What kind of hardware is needed?
The numbers are pretty eye-opening. To meet that demand, we're talking potentially 2 million trucks needed, over 100,000 rail wagons, maybe 250 aircraft, over 100 ships. It's massive. But the key insight here is this potential positive feedback loop.
How so?
Well, AfCFTA drives the demand. That pushes investment in infrastructure. Better infrastructure lowers transport costs. Lower costs then boost intra-African trade even more. It becomes this self-reinforcing cycle, potentially driving real economic growth.
Okay, so there's this massive build-out happening, or needing to happen. How are they weaving in technology and sustainability?
Yeah.
Are those twin transitions, digitalization, decarbonization part of the picture?
Very much so. On the digital front, there's a definite push. Leveraging AI, developing smart ports, using real-time tracking, big data analytics. You see it popping up everywhere. The upcoming GITEX Africa-Morocco event in 2025, for instance, has a big focus on 5G and AI governance specifically for these sectors.
And decarbonization.
Ghana made a really interesting announcement recently. They're aiming to design and actually assemble electric vehicles, EVs, but specifically tailored for African conditions.
Oh, that's smart. Not just importing standard models.
Exactly. And crucially, the plan includes support from hybrid renewable energy charging infrastructure. So it really highlights this growing focus focus across the continent on building climate-resilient and sustainable green infrastructure. It's not an afterthought. It's becoming a core principle. Building smarter, not just bigger.
Okay, let's pivot a bit and focus on aviation. That same week in June 2025 saw some really significant moves there too, particularly around the Paris Air Show.
Yeah, the 55th Paris Air Show was definitely a stage for African carriers. We saw Nigeria's air peace making headlines by securing those coveted London Heathrow slots. South Africa's Airlink announced leases for new Embraer jets. Ethiopian Airlines placed orders for more turboprops. And Rwanda Air picked up the award for Best Regional Airline in Africa. Quite a busy week for the sector.
Let's dig into that Airlink deal. Leasing 10 new Embraer E195-E2s from Azora. What's the strategic play there?
It's all about efficiency. The E195-E2, it offers up to, I think, 29% better fuel efficiency compared to the E190s Airlink currently flies. And it has about 33% more seats.
Okay, so significantly lower cost per seat.
Exactly. That's the core takeaway. This isn't just getting shiny new planes. It's a strategic move to boost operational efficiency. It makes routes that were maybe marginal before potentially profitable now, and it gives them the legs, the ability to expand their network deeper into sub-Saharan Africa. It's a real competitive advantage they're building.
Now, the airpiece story, getting direct flights from Abuja to Heathrow, that sounds like more than just a commercial deal. You mentioned Heathrow slots are coveted.
Oh, it was definitely more. This was framed as a major diplomatic victory for Nigeria. The flights are confirmed 4 times a week, starting October 26, 2025, using Boeing 777s. But reports suggest this happened because of, quote, sustained diplomatic efforts by Nigeria's aviation minister, Festus Keyamo.
What kind of efforts?
Apparently really pushing hard on the bilateral air services agreement, SPABANZA, demanding access to Heathrow to, quote, enforce reciprocity. There were even hints or threats of reciprocal action against UK carriers if access wasn't granted.
Wow, so flexing some muscle.
Pretty much, and that sets a really interesting precedent. For years, many felt foreign carriers had the upper hand on the most lucrative routes into and out of Africa. Nigeria's assertiveness here signals that African governments might be getting, well, more proactive in playing hardball in international air politics. Challenging that dominance, it could definitely reshape things.
But even with wins like that, there's still this underlying tension in African aviation, isn't there? This constant struggle between opening up the skies and protectionism.
Absolutely. It's a persistent, almost frustrating challenge. The stark reality is Africa still only captures about 2% of global air traffic. And intra-African traffic, that's just 20% of Africa's total. It's a deeply fragmented internal market.
And a big reason is those protectionist policies.
Yeah. Over half, more than 52% of the 600-plus bilateral air service agreements between African nations are still restrictive. They limit frequencies, capacity where airlines can fly.
Which seems completely at odds with the goal of the Single African Air Transport Market, SATM.
Exactly. SAM is meant to be like the EU's open skies, creating one unified market, but progress is slow. And until those policies genuinely open up, you add in high operating costs across the continent, and it just prevents African airlines from achieving the economies of scale they desperately need, especially on those intra-African routes. It's a major constraint on growth.
Let's shift gears to the maritime world, ports and shipping. That week also saw some fascinating dynamics involving geopolitics, labor issues, and those ever-present operational headaches.
Definitely. A really big story was Algeria scrapping that massive deepwater port project at El Hamdania. This was a multi-billion-dollar deal, initially involving significant Chinese financing, launched way back in 2015.
Scrapped. Why?
Well, the official line was excessively high costs, but reports strongly suggest there was more to it. A significant diplomatic pivot toward France is how some sources described it. The expectation now is that French companies will take the lead in modernizing Algeria's existing ports instead.
Okay, so that's a major shift. What's the takeaway there?
It's stark. It shows that geopolitical alignment can quite abruptly override established economic partnerships. It introduces this significant new layer of political risk that all foreign investors in Africa now have to factor in much more carefully. Strategic alliances can trump economic logic seemingly overnight.
Meanwhile, down south, a couple of things happened that seemed to bolster stability, right? Transnet in South Africa reached a wage deal.
Yes, a crucial 3-year wage agreement with their unions, a 6% annual increase. This averted what could have been a really crippling strike, providing much-needed labor stability in a sector that's absolutely vital for South Africa's economy and the region's.
And how does that connect to Mozambique?
Well, almost concurrently, Mozambique approved the development plan for the Coral Norte floating liquefied natural gas project FLNG. The connection is synergy. Transnet stability makes big export projects like Coral Norte, which rely on South African ports and rail, seem less risky. It demonstrates a kind of regional commitment to shoring up the logistics backbone for commodity exports. It sends a positive signal.
But despite these positive strategic moves, the day-to-day reality at many African ports is still challenging. We're still seeing major delays.
Unfortunately, yes. The chronic issues persist. You look at the snapshot from that week. Tima in Ghana, delays up to 3 days. Tanger Med in Morocco, up to 4 days. Algiers, over 7 days reported. Even Durban in South Africa, still facing 1-2 day delays. It's a constant operational headwind.
So what's being done on the ground and any innovative solutions?
One interesting development is within Transnet itself. Transnet Engineering TE is actually starting to manufacture its own port handling equipment. Things like haulers, trailers, straddle carriers.
Really? Building their own?
Yeah, partly to tackle equipment shortages directly, but also to build internal capacity and skills. It's a kind of localized, maybe even an import substitution approach to a persistent problem. Beyond that, you still have the wider issues impacting maritime globally, like the UN Ocean Conference calling for a pause on deep-sea mining, and unfortunately persistent piracy concerns, especially in the Gulf of Guinea, adds another layer of risk.
Okay, let's move inland to land transport. Here, that week seemed to show this real duality. Massive corridor building projects, often bankrolled by development finance institutions, DFIs, happening alongside some really stark local problems.
That's a perfect way to put it. You've got the big players like the African Development Bank, AfDB, and the World Bank really pushing to forge these arteries of continental trade. The AfDB especially seems to be the hardware financier.
What do you mean by hardware?
They're funding the big physical stuff. For example, arranging $1.2 billion for Tanzania's standard gauge railway, the SGR, to extend into Burundi and the DRC. That's literally creating a new trade artery. They also celebrated commissioning the 112-kilometer Dodoma Outer Ring Road in Tanzania, mostly AfDB funded, and strategically linked to the Cape to Cairo corridor.
I heard they even renamed that road.
They did, in honor of the AfDB president, Dr. Akinwumi Adesina. And in the DRC, they're funding the rehab of a 622-kilometer stretch of National Road Number 1. That project is expected to cut travel time on that section from weeks down to under a day. Huge impact for the 19 million people in that area. The AfDB is genuinely funding projects that redraw the trade map.
Okay, so if the AfDB is providing the hardware, the physical infrastructure, where does the World Bank fit in? Are they the software?
That's a great analogy, yes. The World Bank seems focused on the software, the market reforms, the regulations. Look at their $1.5 billion loan to South Africa. It wasn't earmarked for building a specific road or railway line. It was explicitly for critical structural reforms, particularly in the freight rail sector.
For firms like what?
The big goals are unbundling the state-owned Transnet, establishing an independent regulator for the rail sector, and crucially, opening the sector up to private competition. They have this ambitious target. Increase the operational capacity of the rail network from its current maybe 25% up to 65% by 2027.
So it's a dual strategy then.
Exactly. The AfDB provides the physical assets and often the high-level political buy-in. The World Bank comes in to reform the market structures, make the operating environment more efficient, more transparent, more attractive to private players. It's about de-risking the whole system, which is critical for attracting that private investment we talked about earlier.
But then, the contrast. While all this high-level corridor building and reform is happening, you get something like the N'Djamena transport strike.
Yeah, that was a real jolt. A 48-hour transport strike on June 19th just paralyzed Chad's capital city, N'Djamena.
What were the issues?
Shockingly basic things. Soaring fuel prices hitting 1,000 CFA francs a liter on the informal market, way above the official 700. Severely deteriorated roads within the city. And just a lack of dialogue, a feeling of being ignored.
It really highlights that macro-micro disconnect you mentioned.
It absolutely does. Billions are being mobilized for these grand Pan-African corridors connecting countries. Yet, a major capital city gets brought to its knees by potholes and fuel cost fundamental last-mile problems. And that disconnect risks undermining the entire economic benefit of the larger projects. What good is a fantastic highway leading into a city if the city itself is gridlocked by local issues?
Let's circle back to those financiers for a moment, the AfDB and the World Bank, just to be really clear on their different roles. The AfDB focused on the physical build-out.
Definitely. Their vision is about building the tangible connectors. We saw it with the Tanzania SGR, $1.2 billion, the Dodoma Ring Road, $138 million, the Salado International Airport, $198 million. Their language is all about regional integration, creating a modern, cost-effective transport system. You can almost call them the venture capitalists for African infrastructure. They fund the physical assets.
And the World Bank, by contrast.
Their approach is reforming the market structure, the operating environment. That $1.5 billion development policy loan to South Africa is the perfect example. It's explicitly for critical structural reforms. Their focus is on things like dismantling state monopolies, setting up independent regulators, creating conditions to crowd in private capital, as they put it. They're more like the turnaround consultant, focusing on how the market conditions and rules for efficiency.
So putting it all together, why is this dual approach, the AfDB building, the World Bank reforming, so important for investment?
Because it tackles both major types of risk for private investors. The AfDB projects create the actual physical opportunity. The World Bank reforms create a more stable, predictable, and potentially profitable operating environment around that opportunity. It significantly reduces both project-specific risk and broader market risk. It makes the whole proposition much more attractive for private capital. It's that crucial 1-2 punch.
Okay, so as we start to wrap this up, let's distill the key takeaways. What are the big strategic trends we've seen emerge from this analysis?
I think 4 dominant trends really stand out. First, the geopolitics of infrastructure. We saw clearly with the Algeria port deal that major projects are becoming instruments of statecraft, adding this layer of unpredictable political risk.
Anyway.
Second, the modernization imperative. There's this urgent drive across the board, aviation, rail, ports, to replace or reform inefficient systems. The focus is intensely on reducing costs and boosting efficiency. Think Airlink's new jets or South Africa's rail reform push.
Okay, third trend.
The policy to project pipeline. This is that positive feedback loop we discussed. AfCFTA is creating real, tangible demand for infrastructure. That demand is being met, at least in part, by DFI funding like the AfDBs. This creates this powerful, self-reinforcing cycle that could drive significant growth.
And the fourth one, that disconnect.
Yes, the macro-micro disconnect. This growing, worrying gap between the investment in large-scale cross-border corridors and the chronic underinvestment in critical urban and local feeder networks, the roads within cities, the links to rural areas. And as the Andy Jimenez strike showed, this really threatens to undermine the full economic impact of the big projects.
So those trends create a landscape of both opportunities and risks. What should people be looking out for?
On the opportunity side, definitely strong demand for aircraft lessors and financiers, especially those offering next-gen, fuel-efficient regional jets like the Embraer's Airlink leased. Also, a potentially significant market opening for private rail operators in South Africa if those reforms stick. And of course, a large and growing market for technology providers, smart port software, AI and logistics, real-time tracking systems.
And the risks to watch.
3 main categories, I'd say. First, political risk. Geopolitical shifts causing abrupt cancellations, like in Algeria. Investors need a robust analysis here. Second, operational risk. Those persistent ground-level problems, port congestion, potential labor instability despite deals like transnets, decaying urban roads, security threats like piracy, these haven't gone away.
And the third risk?
Regulatory risk. The slow pace of implementing things like the Single African Air Transport Market, SATM. Those restrictive bilateral agreements are still a major drag on aviation growth, for example. Policy promises need to translate into action faster.
Okay, so based on all that, what are the key recommendations for the different players involved? Let's start with policymakers.
For policymakers, 2 key things. 1, accelerate the actual implementation of Mayor ATM and the trade facilitation aspects of AfCFTA. Turn agreements into reality on the ground. 2, adopt a more balanced investment strategy. Yes, fund the strategic corridors, but don't neglect the critical last-mile networks, urban mobility, secondary roads, rural feeders. Address that macro-micro disconnect.
And for investors?
For investors. First, build robust geopolitical risk analysis into your due diligence. Don't underestimate it. Second, prioritize projects that have DFI backing, like from the AfDB or World Bank, as they often come with reduced political and financial risk. Third, think about investing not just in the main project, but in the enabling ecosystem around it, things like logistics tech companies or maintenance, repair, and overhaul MRO facilities that support the transport assets.
Makes sense. And finally, for the transport operators themselves, the airlines, the shipping lines, the trucking companies.
For transport operators, Embrace aggressive modernization to drive efficiency. Follow Airlink's example. Don't wait to be forced. And second, be proactive in advocating for market-opening policies. Use successful cases like air peace leveraging diplomacy for Heathrow access as arguments to push for fairer, more open markets elsewhere.
Okay, that brings us towards the end. A lot to think about there. So maybe the final thought to leave with you, our listeners, is this. As Africa pursues this grand vision of a modern, integrated transport network, how can it ensure that this network doesn't just connect nations on a map, but genuinely transforms daily lives in every city, every town, every village?
Yeah, what is the ultimate last mile we're really trying to bridge here? Is it just about moving goods faster, or is it about connecting people to opportunity in a much more fundamental way?
Something to ponder.
Definitely. The potential is enormous, but closing that gap between the grand vision and the daily reality, that remains the core challenge.